All right. Well, we're back for a second time. So yes, believe it or not, this will be the second time I've recorded this second half of the lecture. Um, yeah, I did record it. Unfortunately, there was an error when I finished, and so yes, we're heading through this a second time. So we ended off the last part talking about the auditor's letters and the qualified, unqualified opinion, or modified, unmodified opinion. And so we're going to continue with that. And really what I wanted to do is, pick it up where we left off. We're talking about the unmodified opinion, which basically is, hey, everything looks great, right? So this opinion may be used only when the auditors have obtained sufficient appropriate audit evidence to conclude their financial statements are not misled, or there is no need to alter the report for the following situations. Right? And so I do want to highlight, that these are still unmodified opinions. Oops, I meant to do that in red. Unmodified opinions, However, they have a little explanation behind it, all right? And so the first one, all right, is this with an emphasis of matter, okay? And really, it's just to emphasize, hey, everything is looking fine, all right? However, there's a change in accounting principle. And again, it's not a change, from one generally accepted accounting principle to, for the example that I give way back when we talked about this in financial accounting, all right? Because again, what makes the best auditors? One that has a good understanding of financial accounting, generally accepted accounting principles, all right? And so a change in accounting principle is changing from one generally accepted accounting principle to another. It's not like going from bad debt, all right, when we're talking about bad debt, doing the direct write-off method, right, because that's not GAAP, right, to the allowance method, which is GAAP. All right, so this is a change from one to the other. So we disclose that in an emphasis of matter paragraph. With an other matter paragraph, really what we're identifying there, all right, are things that are not necessarily part of the financial statements, right? Emphasis matter other than those presented or disclosed in the financial statements. Things that are more peripheral in nature. And then the final one is, dealing with group financial statement. Really all that is when we have two different accounting firms that are auditing the same company, maybe there's multiple divisions, maybe, it doesn't make sense to have a firm in, Zimbabwe, but there is a division of the parent company that we need to have audited. So we hire a Zimbabwean, whatever, I don't know what they would be, all right, firm, all right, to do that audit for us. Right? And so we're going to go into more depth of these as we continue. So a qualified opinion, really that's saying, hey, everything looks good except for this, all right? We're looking at, everything looks good except for inventory. They're not applying lower of cost or market, all right? So they are using the historical cost concept, right? But they're not applying the lower of cost or market. Therefore, everything else looks good except for inventory. An adverse opinion, all right, that's the worst, right? They are not in conformity, in conformity with generally accepted accounting principles, all right? Run away, do not trust these numbers. Then finally, a disclaimer of opinion, right? And so for the most part, we're basically saying we don't have enough information in order to make an opinion under that type of auditor's opinion, okay? And so unmodified opinion with additional matters, so we're kind of going back, covering this stuff, all right? So substantial doubt about the company's going concern status. So this is unmodified, okay? But with an additional financial statement related matter, okay? And really there's three issues here. There's the going concern, and going concern is, if you remember when we talk, especially about corporations, we make the assumption that they have an unlimited life, right? And that they're going to last forever. Okay? That's what makes a corporation different from a sole proprietor or partnership, right? But here's the deal: is like we don't even think they're going to make it in the next 5 years, and so that's a going concern. We're concerned that they're not going to make it. The next one is generally accepted accounting principles not consistently applied. All right, so this could be for several different reasons. And then other circumstances that the auditors believe should be emphasized. So we're going to look at those. As I said, the going concern, all right, generally accepted accounting principles assume that the company is a going concern, right? That it's going to last forever. Okay? And so when it shows that it might not last forever, okay, we need to disclose that. And so assets and liabilities are valued on the assumption that the company will continue to operate for a reasonable period of time. Right? We're not guaranteeing them for life. Okay? We're just saying, hey, we think that they're going to last for 10 to 15 years. All right. So with requirements, management must evaluate whether there is substantial doubt about the company's ability to continue in existence for a reasonable period of time, a year from the date of the issuance of the financial statements. So really, it's a year. The auditor is not required to perform procedures specifically designed to test the going concern assumptions, but must evaluate the assumption as a whole. Right? So some conditions that might indicate that we have a going concern: negative cash flow from operations, defaults on loan agreements, adverse financial ratios, work stoppages, legal proceedings, loss of key finance or franchise, customer or supplier, uninsured catastrophe, or dividends in arrears. So as far as the substantial doubt as to going concern, right, here's a little example of a paragraph and how it might be worded. In some cases, okay, it could be given a disclaimer of an opinion, okay, which basically says, hey, we don't have enough information to be able to give an opinion. But I'll let you go ahead and read that paragraph. Consistency in applying of accounting principle. Okay, auditors are required to indicate in the report when a company has changed accounting principles, resulting in a material, okay, that's kind of important, material effect on the financial statements being reported. This requirement pertains to changes in accounting principles, but not changes in estimates. And so if you remember, again, from intermediate accounting, okay, when we talked about changes in accounting, we basically categorize them in 3 different ways. Right? There was change in accounting principle. Again, that's from one generally accepted principle to another. Then there was change on estimates, and then there were, actually, this was 4. Then there was change of entity, right? So where we have consolidated financial statements, and then there was error corrections. Okay, and so if you remember, the bulk of these, all right, dealt with retrospective restatement. Right? And so we had to change the financial statements in previous years. Okay? It's only a few things, okay, like changes in estimates, okay, that we did prospectively. All right? We didn't go backwards, we just changed it moving forward. And so there is a difference between, and that's what they're trying to highlight, between a change in accounting principles and a change in an estimate. In accepting the change, the auditor should evaluate whether the newly adopted principle is generally accepted, because again, it has to be. The method of accounting for the effective change is in conformity with generally accepted accounting principles. The disclosure related to the change is adequate, and that there is a reason behind it. And if, remember, when we talk about it, it can't just be because we want to save money on our taxes. All right, it has to make sense as far as the rationale behind communication. Emphasis of matter when it comes to the lack of consistency, right? Again, the lack of application. In this case, really what it could be is because, the FASB or somebody came out with a new way to handle things, right? These ones, in most cases, are handled prospectively, right? And so 2 years numbers could be substantially different because this year we're using the new rules and last year we're using the older rules. Okay, and so they have a great example here when we're talking about goodwill, right? And so the FASB came out with a new standard, a new way to treat goodwill, all right? And so we don't have to do retroactive restatement on that because the rule wasn't in effect. Okay, last year it was unqualified. All right, we had an unqualified opinion. Under last year's rules, that was right or materially correct. This year, things just changed because there's a new pronouncement that has come out. And so there's going to be a difference. So that's why we need to communicate that as an emphasis matter paragraph. Additional emphasis matter, okay, stuff that's up to the auditor's discretion, right? Maybe there's a risk or an uncertainty that they just don't feel comfortable, all right, not saying something about it, all right? Significant related party transaction, all right? This is just an area that the auditors can get something off their chest, all right? So you can read the rest of those. The next area, all right, deals with group financial statements, all right? And so here we have a conglomerate, okay, has various different subsidiaries, okay? And we're the lead auditors, okay? And basically they're referred to as the group auditors. Okay, so the group auditor, I don't know why I'm unable to write. Okay. The group auditor, hang on. Interesting. All right, I'm unable to draw on my screens now. Boy, we're just having technical difficulties on this last day, aren't we? All right, whatever, we'll continue. But basically, we have, we're the group auditor. Okay, so this is us right here. Oops. Okay. The group auditor. All right, we're auditing both subsidiary A and B, okay, where we're hiring a component auditor to audit C. So let's just say that these are in countries where we have our firms, okay, but this one, right, is in a foreign country, right? So we're hiring an auditor from another country. Oops. Okay. So group engagement teams should obtain understanding of whether the component auditor, okay, are competent and understand, right, and will comply with ethical rules. So let me try this. There, I think we got it now. All right. Again, we're looking for competency. Maybe my battery went dead on my little writer. All right. That could be. I've actually run out of batteries in both my. Oh, there we go. I did. I just unscrewed the top and then screwed it back on. All right. But really, what we're looking here is, that they're competent, right, and ethical. That they can be trusted, right? That they know what they're doing and that they can be trusted. The extent of group engagement, teamwork, and involved with the component auditors, because what we're doing is, we should obtain this understanding. Whether the group engagement team will be able to obtain necessary information, right, on the consolidation process, and then whether the component auditors operate in a regulatory environment that actively oversees the auditors. Right. So here's the deal. Because they're, what did I say, Zimbabwe? Okay. Does Zimbabwe, the government in Zimbabwe, have a structure similar to the FASB that regulates, right, the auditors in their country? Right. Because if they don't, then how can we really trust them? Right. As far as the group financial statements, right, we can communicate with the component auditors, inform component auditors how their work is going to be used, right? Again, communicate their ethical requirements, right? Provide a list of related parties, and communicate significant risk of misstatement. Us being the group auditor, right, or the lead auditor, basically have two ways to treat things, right? We can either, all right, make no reference, right, to those component audits, and we basically just envelop them or include them in our financial statements as a whole. Or, okay, we separate them and say, hey, you know what? we've audited A and B. Okay, C is a significant component of the whole. Okay, and they were audited by this auditor, and they follow these standards and whatnot. Okay, so we could disclose that, and really we're covering our butts, saying, hey, you can trust A and B, but we really don't know about C. And so when we're looking at group financial statements, right, various different, definitions. I'm just going to let you read that. But, so if it's not significant, so if that subsidiary is not significant, we're probably just going to roll that into the whole. Right? But if it's significant, all right, there's various different steps that we would perform as far as our audit procedures. Like I said, you can go ahead and read that. When it comes to the summary of emphasis of matter, all right, these are what we've been discussing. So the going concern, we talked about that. The consistency of GAAP, right? Auditors' discretion, and the group audits. And this is nice because it breaks down the effect on the audit report if the matter is properly presented. Okay. And so you can, like I said, you can read that. But this one is really good because what we're going to be doing here is we're going to be looking at modified. All right, so up to this point, everything has been unmodified or unqualified. Right? And so in this case, unmodified. Right? So if we do find an error, okay, and the error is part of the financial statements, okay, but if it's not material, okay, then we continue with an unmodified opinion. However, okay, if we find that it is material, okay, but it's not pervasive, and again, pervasive, we'll have a definition coming here up in a minute, all right? But pervasive is it's not all the way through their system, okay? But if it's material, okay, we're going to do a qualified opinion. So it's a step down. So this is the best, all right, the second best, and then the worst, okay, is the adverse opinion, all right? The adverse opinion is if it's material and pervasive, right, then we're going to give them an adverse opinion. However, okay, if the inability to obtain sufficient appropriate audit and evidence is not material, okay, then again, we're just going to treat that as unmodified. However, if it's modified, we're going to qualify that, hey, there's not sufficient audit evidence. And here's the big difference versus, okay, so, when it's a misstatement of financial statement versus sufficient audit evidence, okay, it's the difference between the adverse or just a disclaimer. Disclaimer, again, is just saying, hey, we don't have enough information to be able to make a decision. Qualified opinion, departure from GAAP, okay? So a department from, and this is again the same stuff. If it's immaterial, okay, it's unmodified. If it's material, we qualify. And if it's material and pervasive, right, it's adverse. Misstatements become pervasive, all right, and so this is the definition of pervasive, okay, when any of the following applies. Okay? It's not confined to a specific account, all right, we're treating them all incorrectly. If confined, all right, they represent a substantial portion of the financial statements, all right, so let's just say all current assets, all right. Or in relation to disclosure, they are fundamental to the user's understanding of the financial statements. So an example of a non-public, again, this is, small GAAP, if you want to think of it that way, all right, or privately held corporations, right? They're not on the open stock market. An example of a qualified because of a department or a departure from GAAP, right? And so, in our opinion, except for the effects not capitalized. All right, so in this case, if you remember, we had the two different types of leases, okay? And I don't remember the current terminology, but, it was the difference between a capital lease, all right, and an operating lease. Okay, operating leases, we just expense them. A capital lease, we actually put them on our books, right? And so what's happening in this scenario is that this company has been treating things as an operating lease, just expensing, when they should have been capitalizing. All right, and so it lists the effects. Okay, if these lease obligations were capitalized, right, we'd increase our assets, okay, leased assets by 15 million. Our leased liabilities, right, the present value of the minimum lease payments, and then the difference is going to go off to retained earnings, right, and that retained earnings is going to have the impact on net income and our earnings per share. So this would be the example of a public report, okay, publicly traded company, very similar, all right. It discloses that same information down here, okay, and it says, except for the effects of not capitalizing the lease, and so very similar, just a little bit more wordy when we come, with public companies, ones that are under the Public Company Accounting Oversight Board. Adverse opinions. Okay, now I have posted on the Moodle page a client that PricewaterhouseCoopers had, where they actually gave them an adverse opinion. Right? And for the most part, it does not, okay, present fairly the financial position of an organization in accordance or conformity with GAAP. All right, so I think the one that I posted, it's an insurance company, and they're just not following GAAP at all. All right, they're following, I guess, some sort of insurance standards. Okay? So I don't know why they're paying for this audit unless it's required by their bank or something like that. But yeah, it's material and pervasive, to the two parts that need to be there for an adverse opinion. Okay? The auditor believes departure causes financial statements taken as a whole to be misleading. Example of an adverse opinion, right? And so, because of the significance of the matter discussed for the basic adverse opinion paragraph, the consolidated financial statements referred to above do not express fairly the financial position of Wind Company as of December 31st, 2008, and the results of its operations and its cash flows for the year then ended. Next, we're going to be looking at qualified opinion, all right? And so again, this is kind of middle tier. It's not adverse, okay, but it's a qualified, so we're qualifying something, right? And in this case, it's because of lack of significant appropriate audit evidence, right? Or what's referred to as a scope limitation. Scope limitation, right, could be imposed because of circumstances, right? Important accounting records were destroyed. And so when I was in Hawaii, we had a client who was on Guam, right? And Guam got hit by a hurricane, and they lost a bunch of, they lost their whole building, right? Not just some records, all right? And so, there's not the ability to look at those supporting statements. It also could be because of, the nature of the audit. Okay? The engagement was too late in the year to observe the client's beginning inventory. So this also happens, when there's a change, right, between one accounting firm and the other. Or it could be imposed by the client, right? The client refuses to allow auditors to send confirmations to customers. Again, we're qualifying something here. Sometimes this leads to a disclaimer, right, as opposed to a qualification, because we can't, we're going to disclaim we can't verify this because our client or the client won't mail out those confirmations. So here's some example, all right, of qualified reports, scope limitations. Again, you can read those. I've read a lot already. All right. Finally, disclaimer of opinion. Right? The auditor has no opinion because there's not enough evidence to make an opinion. Issued whenever the auditor is unable to form an opinion, right, as to the fairness of the financial statements. Circumstances resulting in the disclaimer are those in which the possible misstatements are material and pervasive. So multiple uncertainties may also lead to a disclaimer. Kind of that's important is that this is not an alternative to an adverse opinion. All right, so if you're finding things that are telling you that, hey, they're not in conformity with generally accepted accounting principles. You can't give an adverse opinion just to get out of, you know, or I'm sorry, give a disclaimer to get out of giving an adverse opinion. The reason that adverse opinion, one of the reasons the adverse opinions are so infrequent is because accounting firms don't want to give adverse opinions. Right? They generate bad publicity, if you want to think of it that way, because again, accounting firms are trying to attract clients because that's how they make money, right? And so if you're known for giving a bunch of adverse opinions, you're not going to get those clients, are you? So that's really the rationale behind it. So here's an example of scope limitation, all right? And the scope limitation, you know, as an example, is our responsibility to express an opinion on these financial statements based on conducting the audit in accordance with auditing standards generally accepted in the United States because of the matter described, all right? In our opinion, we are unable to significantly approximate audit evidence to provide a basis for the opinion, right? Or we cannot, nor were we able to satisfy ourselves with the carrying value of the investment in a foreign affiliate, right? So they're disclaiming a component of that. 2 or more modifications, all right? So it is possible to have a unqualified, or I'm sorry, not unqualified, but to qualify 2 different things, right? And so it could be qualified for both a scope and departure from GAAP. The wording would basically highlight the 2 different things, right? The auditor should consider the cumulative effect, okay, that would have, right, on the numbers. And so you can have 2 qualifications that, hey, inventory and leases aren't being treated correctly. Different opinions on different statements. It is possible, okay, to say, hey, the income statement's good, but the balance sheets can't be trusted, all right? Or vice versa. The balance sheet, information is accurate, okay, but we can't verify, or we're going to give a qualified opinion on the income statement. So it's acceptable to express an unqualified opinion on one statement while expressing a qualified or adverse opinion on others. Okay, so here is an example. Auditors retained after the client has taken its beginning inventory, so we can't verify beginning inventory, but we can verify the year end, okay, which gives us the balance sheet information. And so we're not able to calculate the income statement number because we didn't have beginning inventory, plus purchases gives us goods available for sale, subtract ending inventory. We took the ending inventory, and so we're able to get, we were not able to construct cost of goods sold, right, which then flows to the income statement. But ending inventory is what's shown on the balance sheet, so that must agree. Reporting on comparative financial statements, right? Reports should cover current year as well as prior period audited by their firm. Okay? And so it is possible to give a qualified opinion one year and an unqualified opinion the next. Right? And so that's what they're talking about here. It can express different opinions on different years. The auditor should update the report for all prior periods presented for comparison purposes. And if the prior period was audited by another or a predecessor, right, CPA firm, the current year operation, right, or opinion only covers what we've audited, right? I mean, it doesn't make sense that we're like, yeah, we trust, our predecessor's numbers. No, there's 2 years presented, and there has to be 2 years, right? We're only going to give our opinion on the current period. For financial statements audited by the predecessor, right? Either, okay, they're going to reissue report as of the original date, or okay, the current auditor refers to report of another auditor. Okay, so hey, last year it was audited by Smith and Wesson, and you can if you're going to sue anybody, all right, you can sue those guys. Reports to the SEC, okay. again, I posted Harley Davidson's. It's a few years ago. I think it's 2014 or earlier. All right, but I basically posted their 10K. All right, and what that is the annual report, okay, that publicly traded companies have to send to the SEC. You know, there's a quarterly, an annual, all right? Others should be well versed in the requirements of each of these forms. Okay? And so again, as you, you know, advance through with your auditing firm, okay, you'll get a strong understanding of all these when you're auditing a publicly traded company. Something that's kind of interesting with those annual reports, especially, is they have to disclose, you know, the key management, you know, CEOs, CFOs, their salaries. All right, so it's always interesting to see what they're making. You know, so you can kind of get an idea of how much money you could make, right, if you moved into the private sector. You know, there used to be this. Well, in the format, there's this thing called Edgar, right? And so when these companies submit their these 10Ks and stuff like that, it's in this form, Edgar. I think it's what's it, Electronic Data Government. I don't know what it actually stands. It's an acronym, right? But there used to be this thing that PricewaterhouseCoopers would supply, which was called an Edgar scan, which would basically convert all the information into a more readable user format. But I looked into it a few years ago, and now they're charging to use that. So I obviously am not going to make it required for anything. So that's it. All right. So I just wanted to say you guys have done a great job. Way to stick it out through, you know, this unprecedented pandemic and semester. I am really proud of you guys. Some of you guys I know are going to be graduating. You know, I wish you the best luck. I hope that you would stay in contact with me and hopefully even maybe volunteer to be on my advisory board so that you can you know, help students who are walking in your footsteps know that they are learning what they need to know. For the rest of you guys, I hope I see you guys in the fall. And if not, I wish you great success in your life and your career.